The impact on the markets as well to be discussed. Nitin Rakesh, CEO of Motilal Oswal Asset Management Company, joins us.
Right, from a market perspective then, Nitin, there would be an expectation that the government would do something to improve the trading volumes. I mean, a lot of effort has been made by the regulator to do so, but there's much talk about doing away with the STT and bringing back the short-term capital gains tax. What's the broad sense on what could come out in the budget for the markets that could change sentiment in some way?
I think one thing is very clear. This is not a big bang, reforms-oriented budget, because most of the key items that were supposed to have been reform-oriented, whether it was FDI or any such, movement, is obviously not going to be tabled at the budget tomorrow. So it's really much more of a revenue and expenditure budget than anything else. Market is expecting a little bit of news on the STT front, whether it's lowering. I don't think abolition is actually on the cards yet, given the pressure already on the government finances. So clearly, I think what we need to wait and watch for is what are the key revenue and fiscal consolidation steps that the finance minister plays out tomorrow. There's clearly an expectation that the 2% excise cut that was given to boost demand in 2008-9 timeframe will be rolled back. Service tax, a much bigger net with a negative list is going to come in. That's clearly going to give a boost to the revenues front. I'm sure there will be some movement on expansion on import duties, especially on the so-called quote-unquote luxury items, and I think that's much more symbolic than as well as revenue generation. So I think it's not really so much about any big bang changes. I think the issue really is how much of elbow room they can get purely from a revenue point of view, and which those heads of revenues are where they can actually project growth.
5%, Nitin. For FY13, anything below 5% is something that the markets are probably going to like a lot. The question mark really is over whether he can outline, even in a restricted manner, a credible plan in order to be able to achieve that, because a lot of people will now start believing that figures that are given out in the budget are probably a bit of a hogwash as well, considering the state of finances for the 12 months following the budget, as has happened the last 12 months actually.
I think you said it. I mean, the key really is how credible that number is, and in the end, it shouldn't just be a statistic. I mean, there's no reason why it should be 5% and not 4.5%. So clearly, I think the market is going to look for how credible that is, how achievable that is, which heads of revenue, for example, are being budgeted for. I mean, this investment was a damn squib last year. We only did 25-30% of what was supposed to have been done. But then again, I think there are other sources of revenue, whether it comes from telecom space, whether it and those could be one-time big ticket revenue items. So I think the issue really is not so much what that number quoted is. The issue really is that a credible number? Can we get to that number in a reasonable manner without actually having to take big leaps of faith as we did in the last 12 months?
Nitin, let's try and just running out of time. So let's try and focus on a couple of spaces which you believe would find some mention in the budget and therefore could have a positive or negative reaction. I mean, there was talk of import duty on LNG being cut. Maybe a given is an increase in excise duty, if not across the board, then at least on autos. Anything that you specifically believe will come about and would have a reaction?
I think clearly the expectation is that there will be some tinkering with excise duty, especially on autos, because that was a kind of an incentive given in the slowdown phase of 2008-9. In addition to that, I think the market is also going to look for what the finance minister can do from the point of view of promoting investments, because clearly if you see the two sections in the economy, I think consumption is very robust across all levels. That's not really the issue. The issue really is investments haven't really picked up over the last 18 to 24 months, partly because of high inflation, high interest rate environment, and partly also because I think there needs to be a trigger to incentivize investments further. So I think that is something that the market will look for. In what shape and form that's going to be, whether it's tinkering with the depreciation laws, whether it's something else, I think those are the things that we need to watch out for in addition to the excise and the indirect tax structures.
7.5%, 7.6 to be precise, and that's a number, Nitin, that we would have probably worked with any which ways coming up from the government side.
Sure. Again, I think as I said, a 5% deficit target, 7.5% growth target is something that you have to assume as table stakes, because that's what the government needs to push through. Again, the credible thing will be how we get there, how these numbers add up tomorrow, and I think that's probably the biggest thing the market is going to look for from the budget, rather than any big bang announcements.
Specific sectors, Nitin. Now, I mean, aside of the budget and stuff like that, what do you do with say a couple of key suspects, the ones which are off in trade, infrastructure? I mean, lots been spoken about how great value they project, etc., so on and so forth. Are you a buyer into these stocks, the mid-sized infrastructure names?
Again, I think, at least we've been very consistent that just because something is cheap isn't a good time to buy them. So yes, you can always take a contra-cyclical view, but I think the only sector that we bet on from an interest rate sensitive perspective was banking. And that is primarily because I think the cycle is very clearly turned almost 3 months ago. So I think that segment continues to be one of our top favorites. Other than that, I think consumption really is still the right place to be in, because despite everything that went wrong in the last 12 months, consumption held up really well. We still think there's a lot of steam left, because the whole consumer spending and discretionary power game is still to be played out over the next few years in India. So it's a secular mega trend that you have to bet on. We still aren't very fully convinced about the fact that things like infrastructure, construction, real estate will give you any sustainable gains. Yes, they will be trading plays. So if you have the ability to pick them at the right time, then definitely it's a trading play, but not so much from an investment point of view.
The build-up in infrastructure, Nitin, do you think it's been overdone, especially in the rally that we saw so far? I mean, you think that it's played out a bit too much, and perhaps what may come out of the budget may not match targets?
I think so. I think, again, obviously things sometimes run ahead of fundamentals. So, the expectation was that market rally or liquidity fueled by a lot of foreign flows will actually improve the fundamentals, and I think that remains to be seen. So clearly they had run up in anticipation of a lot of things happening, especially on the interest rate side. But I don't think just falling interest rates will actually lead to a reversal of the investment cycle. That's what the bigger problem with infrastructure is. I think you have to wait and watch and see what specifically can happen from expanding the infrastructure, the investment cycle per se, rather than just the cut in interest rates.
Okay.